Welcome to The Explainer. Today, we are cutting right through all the noise. So, a recession, what does that really mean for your money? But here's the real question. What does history tell us about not just surviving one, but maybe even thriving through one? Let's find out.
You hear this chatter everywhere, right? A recession is coming this month, next year. And this constant drumbeat, it just creates a whole lot of uncertainty and, let's be honest, a lot of anxiety for investors. Okay, so with all that noise, what are you actually supposed to do when the headlines are screaming recession? Well, let's cut through it. We're going to look at history and some really fascinating data to build a clear playbook for protecting and maybe even growing your portfolio when the economy gets rocky.
All right, so first things first. Before we can even talk strategy, we need to know what we're up against. It is absolutely critical to understand the difference between a normal market dip and a true recessionary bear market, because they are not the same thing at all.
Okay, so here's the main distinction. A market correction, that's a drop of, say, 10 to 20%. Think of that as kind of normal. It's like the market taking a breath. It happens. But a recessionary bear market, whoa, that's a whole different animal. That's a drop of 20% or more, and it signals a much deeper economic problem. Knowing which one you're actually facing is step one. And just to put things in perspective right now, despite all the recent panic, the S&P 500 is only down about 6% from its peak. That's not even close to correction territory, let alone a bear market. It's just a normal pullback.
And this really puts that little 6% dip into perspective. After a massive 71% run-up over the last couple of years, a small pullback like this, totally normal. The big takeaway here? The market is not screaming recession. At least not yet.
Okay, so let's say a real recession does hit. Then what? Where does the smart money go? Well, a really great analysis from Morningstar gives us a super clear, data-driven look at how different assets have performed when things get tough. And check this out. What's so fascinating here is just how stark the difference is. You can see this clear flight to safety during recessions. Investors are basically looking for a safe place to park their cash, so they pile into stuff like gold and U.S. Treasury bonds. And on the flip side, the things that need a strong economy to do well, like commodities and emerging market stocks, they take a pretty big hit, as you'd expect. Let's just zero in on gold for a second. Look at this track record. You've got three totally different kinds of recessions here. The high inflation mess in 1980, the big financial meltdown in '08, and that crazy COVID shock in 2020. And what happened? Gold consistently delivered positive returns. This right here is exactly why it's earned that reputation as the classic safe haven asset. Okay, but what if you're not ready to just sell all your stocks and run for the hills? I get it. Well, the good news is you might not have to. See, even within the stock market, there are these defensive sectors that kind of act like hiding places during a storm. And the logic here is actually pretty straightforward. The thinking is, no matter how bad things get, people still need to see a doctor, right? They still need to buy medicine. They still need to buy, toilet paper and soap. These are the non-negotiables, and that makes sectors like healthcare and consumer staples incredibly resilient. And it's the same idea for companies that actually mine precious metals because they benefit from that big rush into gold we just talked about. Now, on the flip side, some sectors just get absolutely hammered. Think about it. When the economy shrinks and you're worried about your job, are you going to go buy a new car? Probably not. You put off those big purchases. And that just craters the consumer cyclical sector. And it's the same story for energy and industrials. A slowing economy means less demand for oil and raw materials. It's a direct hit. So this brings us to a really crucial idea: quality stocks. I want you to think of these as the financial fortresses of the stock market. These are your fundamentally strong companies. Low debt, great cash flow, and a track record of making it through tough times. Now look, no stock is totally immune, but these quality names, they tend to get hurt less, and this is the important part, they recover so much faster on the other side. Okay, so let's recap. We've defined the battlefield, we've looked at the historical winners and losers, and we've found the hiding spots in the stock market. Now let's put it all together into a simple, actionable playbook for you to think about when a recession hits. So here it is, a 4-step framework based on everything we've just seen. Step 1, think about reducing your overall exposure to the stuff that gets hit the hardest, broad market stocks and commodities. Step 2, you seek safety. Shift some of your portfolio toward those proven safe havens. Gold, that timeless store of value, and U.S. Treasury bonds, which are, backed by the U.S. government. Step 3, if you're going to stay in stocks, play defense. Lean into those resilient sectors like healthcare. And finally, step 4, in whatever sector you're in, focus on quality. Prioritize those strong companies that are really built to last.
And really, that's the bottom line here. Economic cycles, they're inevitable. A recession is going to happen eventually. It's not a question of if, it's a question of when. So the real question you have to ask yourself is my portfolio ready? By understanding this historical data and having a clear playbook, you can move from feeling that anxiety and uncertainty to feeling confident and having a plan. You'll be ready to navigate whatever the market decides to throw your way next.